Hello, this is Brian Rezny, president of Rezny Wealth Management. I'm bringing you an important update about the economy and the investment markets. So, of course, you can understand what we see in the global landscape. Every single week on our TV and our radio shows that I do, I talk about the economy and how investors should be properly positioned so you can capture quality returns in your portfolio and also protect the major downside from recessionary events like we had in 2008, which a lot of investors still firmly remember, or maybe in 2000 in that recession, where both times the S&P 500 dropped over 50%. Investors, retirees, pre-retirees lost a lot of money. One of the key differences with a firm like Rezny Wealth Management, we firmly believe in providing quality returns when things are good, but more importantly, protecting our clients' portfolio from those, again, catastrophic meltdowns like investors saw in 2008. We do not want to have investors subject to that kind of volatility, and I firmly believe by running a detailed investment strategy, which includes risk management, is more important than ever. You know, I look at the economy this year, I look at the stock market, which is doing pretty decent overall. We've had a little bit of this seesaw pattern, but generally speaking, we're seeing some good positive returns across the board, and of course for our clients. I think too many investors, though, falsely believe that their investment person that they're currently utilizing is really more than a broker. A lot of these firms, of course, sell investment products, whether it's the big Wall Street firms or whether it's the small broker dealers or insurance companies or the local rep at the bank. But at the end of the day, running an investment strategy, which includes risk management, is more important than ever. In fact, today I want to talk about, are we headed for a major correction? The reason why I want to talk about this, I bring back 2008 and I bring back 2000 when the markets again dropped about 50%. The number one question that I receive on my TV and radio shows all the time is, Brian, are we headed for another 2008 correction? Is my portfolio going to drop 30, 40, 50%, or is there a chance of that? And again, I hear that from a lot of our listeners just like you. The key factor is this. What causes major market sell-offs like 2008 or in 2000 recession is a slowdown in the economy, which basically brings down corporate profits. Corporate profits drive equity prices or stock prices on the upside, and of course, if corporate profits reverse, they come to the downside. Again, I don't see a major correction currently coming because if I look at our recessionary indicators that we use, not only things that we put together proprietary in-house at Rezny Wealth Management, but other good research that we subscribe to, we currently don't see recessionary environments building, and so we can really look out about 9 months or so and get a good indication where we see the economy trending. And currently, again, our positions can change at any time, and so can our viewpoint if the data changes. But right now, we see a nice meandering upside to the overall economy and earnings, which should bode well for the stock markets, not only here, but potentially around the world. Know when to sell is going to be your big key indicator for any of your investment positions. The problem that most investors face is they randomly buy investments from their broker or their advisor, who really is just a broker with a fancy title. A lot of you listening to me today, what happened to your portfolio in 2000? Did your portfolio drop 30, 40, 50%? Chances are you're dealing with a broker who calls himself an advisor or a financial consultant or wealth manager, but they may not actually manage your money at all, and we'll talk more about that today. Emotions and lack of investment strategy, which include risk management. Again, I go back to this one a lot, and I try to educate investors simply this. When you do good research on investments and you purchase an investment in your portfolio, not only do you have to know what to buy and when to buy, but more importantly, before you buy that investment, you want to know when to sell that investment when things change. Sometimes this means, as an example, you would not want to own equities or stock mutual funds in a recessionary environment. As the economy starts to peak and starts to roll over, corporate earnings traditionally follow on the downside. There are a lot of great indicators that we use and also available to the general public that allow you to look at the economy and how things are growing and earnings to see if these are slowing down, and is it a signal to start selling equities before your portfolio goes down 50% again, like in the recession of 2000 and in 2008. I find 90% of investors falsely believe their broker is actually watching their investments. Let me explain. Most individuals like you that come into our offices, not only in Naples and Fort Myers, but Boca Raton and Coral Gables, we hear this all the time. I thought my broker or my advisor was watching my money. Sad fact is, 90% of our radio and TV listeners and the people who are currently utilizing a firm are probably have a brokerage account, and they really have a broker, not an advisor at all. Remember, most of these firms will use fancy titles like wealth manager. These people with wealth management titles aren't managing any wealth at all. They're really acting as a broker. At the end of the day, if you're not under a registered investment advisory agreement, under an advisory account, not a brokerage account, you're not in a managed account at all. So again, most of these firms do what I call asset allocation. They buy and hold, they sell investments that their firms represent, manufacture and sell. They sit in your portfolio. You get a quarterly phone call from Mr. Advisor. It's warm and fuzzy. He exchanges comments about the grandkids. He reminds you of your grandson or your son. But at the end of the day, they're not really managing your money at all. So what you need to understand is while that person might be a really nice person, if they're not managing your money, can you subject your portfolio to another 50% decrease in the next recession? Buying high and selling low. Investors time it wrong time and time again. Delbar is an independent company that basically looks at and does annual studies of investors just like you. They look at your brokerage accounts. They look at your mutual funds. They basically take a look at how the average investor's return compared to the average investment return. And unfortunately, the average investor misses the returns by a country mile, meaning because your money was never managed and because most investors don't follow a strict discipline on what to buy and when to sell, investors tend to buy high and they tend to sell low. I can tell you in the last 5 years alone at my firm, we have probably had at least 20 to 30 new clients that have hired my firm to manage their wealth that told me, Brian, we sold at the bottom because our broker or advisor never called us and we didn't know what to do and we thought our money was going to zero. The sad fact is this, the time to find out that your broker is actually not managing your money at all is not after your money's down 50%. The best way to do it is this, go to my website, reznywealth.com. For free, you can download our special report, Your Number One Risk as an Investor. This is your number one or your biggest risk as an investor is to falsely believe your broker or your advisor is actually managing your money and controlling risk. Go to my website, reznywealth.com. You can download that report for free. Tom in Naples, Florida. Should we sell in May and go away? I hear this all the time. Tom, that's a great question, and I receive that question a lot around this time of year. Now again, sell in May, go away has a good buzz tag. It doesn't actually work. In fact, statistically speaking, about 58 to 60% of the time frame from May through November is actually positive. So following an investment strategy that says you should always sell in May and go away and then rebuy equities as an example sometime after November is really misleading and it doesn't work. In fact, if I look at, let's say, this year in May, actually, if you were not invested in May, you would have missed substantial returns, well over 2% on your overall portfolio if you missed the equity returns. A lot of investors, again, you hear these buzzwords, you hear these buzz phrases. Does the strategy work? Is it realistic? How do you deploy that in your portfolio? Again, just because you hear these buzzwords doesn't mean it actually works. And often investors who follow strategies that really are not strategies at all will actually hurt their portfolio. I go back to what I talked about earlier about investors tend to buy high and they sell low. The key difference with an investment strategy is this. Your strategy needs to dictate why you are buying something. Where's the value? Remember, I always try to discuss, you want to buy investments that are relatively strong in an uptrend. Never, ever buy investments that are starting to roll over and go into a downtrend and become relatively weak. In fact, investments that are starting to roll over and become relatively weak is a reason you'd want to sell that investment. So again, by buying investments in an uptrend, having a sell discipline as they get weak and selling that and rebuying something that's financially stronger or relatively stronger is a great opportunity and a great way to build that into your investment strategy. Dennis in Fort Myers, Florida. I am 65. The firm I'm working with suggested a security benefit annuity with an income rider. $500,000 and I get $26,000 a year for life. What do you think? I think, Dennis, that would be a huge mistake. Clearly, the person that you're working with that's selling that security benefit, by the way, this is one of these equity index or fixed equity index annuities, is clearly not an advisor at all. They're not fee only, and they're not working in a fiduciary capacity. Fiduciary means working in your best interest. They're working under what's called suitability. But do not buy it. First off, you said you're 65 years of age. Number two, you're talking about putting $500,000 into this annuity. When you put that money in there, you're going to lock your money up with insane surrender penalties that last for an insane number of years. Okay, that's number one. Number two, they're telling you that you're going to get $26,000 a year for life on this income rider. Dennis, do the math. If you put $500,000 into the security benefit equity index annuity and you get $26,000 a year, it's going to take you almost 20 years, 20 years to get your own money back. So Dennis, if you live to age 85, you've gotten your own money back and no return on your money. That doesn't sound like a good investment to me. Now, it's a great commission generator for the annuity salesperson who's trying to sell this annuity to you, but it's not good for your portfolio. The other problem, Dennis, is think about this. The $26,000 you're getting today that supposedly you get for life has no inflation protection. So $26,000 today is $26,000 5 years from now, and 10 years from now, and so on. At a 3% inflation factor alone, Dennis, you're going to lose 15% of your purchasing power on that $26,000 just in 5 years. You're going to lose over 30% in 10 years. Can you afford to live on less money each year because your spending power is actually going down? Of course not. I can tell you I've seen a lot of investors who have not only called our TV and radio shows with questions on these same kind of annuities, and believe me, the security benefit isn't the only company out there. Most of these annuities are very similar, so don't think one's worse than the other. They generally all tend to be very bad investments for the investor. But these insurance salesmen love to sell them because they pay huge, lavish commissions that line their pocket, and it puts your retirement, Dennis, at the end of the line. I always tell investors, avoid annuities at all costs. Anybody who's selling an annuity is not a real advisor, they're not a fiduciary, and their interests are far different than yours. Their sales, they've got a great sales pitch, and I know they remind you of your grandson or your son, but at the end of the day, that's not going to pay your retirement bill. Don't be sold an annuity. In fact, I would suggest you go to my website, ReznyWealth.com. You can download for free our annuity report, why annuities are dangerous to your wealth and retirement. We give you more statistics why annuities are expensive, cost-ridden, rob your returns, rob your retirement. Go there right now at ReznyWealth.com. You'll be glad you did. I'm going to take a short break. I'll be right back with your calls, your questions after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Every single week I receive dozens of phone calls on my TV and radio show from disgruntled investors who were sold an annuity that didn't belong in their portfolio. Don't let your retirement be taken to the woodshed. Read my free report, Why Annuities Are Dangerous to Your Wealth and Retirement. Go to ReznyWealth.com right now. And we're back. Of course, if you have questions about your portfolio, you can send me an email question to brianrezny@reznywealth.com. You can also visit our website, reznywealth.com, and you can download any of our free reports. I know we're getting a lot of calls and we get a lot of questions on my TV and radio shows all the time. By the way, I do have a live radio show every Sunday that plays throughout Florida from 10 a.m. to noon Eastern. We also take a lot of call-in questions for that. We love taking your questions. We love taking your calls. We love helping you make better decisions about your portfolio. One of the things, again, that I talked about earlier, and again, I don't want to harp on this too much, but investors, the problem that happens to too many investors is they don't do the basic due diligence or research on the firm that they're going to entrust their life savings. Most people hire firms because the guy has a fuzzy personality. He reminds them of their grandson or their son or their daughter or whatever it is. At the end of the day, there's two kinds of advisors. There's real advisors who actually manage your money. Those would be fee-only registered investment advisory firms, not fee-based and not commission-based. The other side of the fence is purely sales. These would be these commission-based and often fee-based firms that supposedly help you out. But the problem is, when you're dealing with these people on commission, they work under what's called suitability. Suitability means they can sell you a moldy loaf of $3 bread because you're suitable to buy a moldy loaf of $3 bread, when a $1.50 wholesome loaf of bread is better for you. A couple signs that you're working with a commission firm that's not working in your best interest. If somebody's ever sold you an annuity, if somebody sold you mutual funds for commissions, structured products, these alternative hedge funds, things of that nature. These are often the worst of the worst salespeople and the products that don't belong in your portfolio. Number one on my hit list, by the way, are non-publicly traded REITs. If you've been sold one of these real estate investment trusts that are non-publicly traded, I can pretty much guarantee you you're not working with a fee-only firm, and that person's interest was aligned their pockets and not yours. Check out the firm you entrust your money. Better yet, go to my website, reznywealth.com, download my free report, your number one investment risk that you need to avoid. It's available free on my website. Phil in Fort Myers, do you prefer large cap stocks over small cap stocks? Phil, I don't prefer one over the other. It depends on relative strength. At our firm, we run a very strict investment strategy off relative strength. We do look at small cap, mid cap, and large cap. And to put that in perspective, large cap companies are, generally speaking, companies that everybody's heard of. The Exxon Mobils, the AT&Ts. Those aren't necessarily your best investments, by the way, but typically if I look at an account that we take over the management of, most investors are typically sold large cap stocks or large cap mutual funds because it's easier for the broker to sell you what you're familiar with versus what's really good for your portfolio. Do I prefer small cap stocks over large? Often, yes, if they're relatively strong. Statistically speaking, though, small caps have outperformed large caps over many periods of time, not only rolling 1 and 3 and 5 year periods, but even 10-year periods and longer. Small caps are an important part of a portfolio when relatively strong, especially coming out of recessions in the next 3 to 5 years, because you often find small cap will greatly outperform large cap, often by 50 to 100% in better returns. Not a guarantee of the future, but basically it seems to rhyme. So I would not exclude small cap, and if your portfolio consists of mainly large cap stock or stock mutual funds, you're missing the boat. By the way, most investors have 90+% of their investments invested in large cap stocks or mutual funds and bond funds, primarily in the U.S. You're missing all the other asset categories. So look at everything, exclude nothing, and own what's appropriate for the portfolio, and that's in an uptrend and relatively strong. Tom in Bonita Springs, Florida. I have 3 high-yield bond funds, approximately 70% of my investment portfolio. I need income. What do you think? Tom, great question. First off, I want to stress this. All bonds are not the same. High-yield bonds are a different asset category, kind of like my previous question with large and small cap stock. So at the end of the day, high yield bonds or bond funds are as risky or can be as volatile and go down as much or more in a recession when things slow down as equity stocks can. In fact, if you look at a 2000 and 2008 recession, high yield bonds and bond funds dropped as much or more than the equity markets did. First off, I would not own 70% of your money in 3 high yield bond funds. Huge mistake. Number 2, you are buying one of the most expensive classes of bonds, high yield bonds currently, given where rates are and the valuation of high yield bonds. So you have very little upside potential on high yield bonds now, and you have a tremendous amount of downside risk. I would prefer equities over high yield bonds, hands down. Not only can you get a decent dividend on a lot of equities right now, but the valuations are not outstretched like high yield bonds. You're taking mass amount of risk again, and you have very limited upside, but a huge amount of downside. To put it simple, your downside is a level 10 down, your upside is maybe a level 1. So you're basically taking 10 times the risk for 1 times the upside. You better go to Vegas. You'll probably have a better shot of making a return on your money. Lynn in Marco Island, Florida. What do you think of investing in the oil sector? I think the oil sector, generally speaking, is actually a good long-term prospect. If you're going to invest in oil, though, Lynn, I would not just buy a couple individual stocks. I would look at some ETFs. An ETF is an exchange-traded fund. There's about a half a dozen to a dozen ETFs that buy either the big integrated oil companies or the service company side of the oil market. I think oil is going to be a long-term opportunity for investors. It doesn't mean it's not going to have bumps in the road. And again, in recessionary environments, oil stocks also go down just like most stocks do. So what I would say is if you're looking at oil, look at a sector-specific ETF that gives you better, broader diversification than buying 2 or 3 individual oil stocks. Also, you own a basket of these, so it's a lot easier to do your homework on an ETF and own a basket than buying 2 or 3 individual stocks. You'll probably have a lot more volatility and probably make a lot less money. Watson in Miami, Florida. I'm 34 years old. I have $41,000 in my 401k plan. Where do you think that money should be invested? Watson, great question. First off, most 401k plans have very limited investments to pick from. Often 10 to 15 is kind of a statistical number. What I would suggest is this: if you're a longer-term investor, which you should be at your age 34, and you're looking to grow some of this money, I would tend to have a bigger helping in small and mid-cap in the capitalization rating or ranking of all of the funds in your 401k plan. So look at your 401k plan, look at the investment options, try and single out small cap and mid cap overall in your portfolio. You can also look at large cap, but what I would probably want to do if you're trying to grow this money is I'd want about a 40% allocation to the small cap side, about a 40% allocation to the mid cap side, and then you could put the balance in large cap. I would like to really see the overall investment options you have to pick from, and maybe I can exchange an email back with you to help you better select an overall approach to that plan. But great question. One of the things I want to stress, though, is one day when you do retire, or if you do leave your job, Watson, roll that 401k plan over into a self-directed IRA account, because now you have unlimited investment options, often much better investment choices at a much lower cost structure. You can also then hire a firm like Rezny Wealth Management to help properly manage that portfolio if you don't have the time, discipline, or talent to manage your own money. Phil in Naples, Florida. Markets at all-time high, good time to sell. Phil, that's a great question. It's almost a great comment. That comment would have been true a year ago, 3 years ago, 10 years ago. The markets, generally speaking, if you look at the last 50, 60, 70 years, the market has generally been trading at a new high. Just because the market's at a high doesn't mean it can't go a lot higher. If you would have said back in let's say 85 to me, the market's at an all-time high, well, if you look at from 85 to now, the market's gone up hundreds and hundreds of percent since then. Can the market continue to go up? Yes, if corporate earnings continue to go up. Remember, what drives stock valuations are earnings. If earnings go up, it has an opportunity to drive stock prices higher. We see a generally improving U.S. economy and other economies around the world. That should bode well for higher earnings. If earnings go up, we have a chance for the market to continue to trend higher. But that doesn't mean you need to be complacent, and it's more important that you have a risk management strategy in place. So if you don't know when to sell, if you don't have risk management, or you're unable to manage your own money, I would suggest you call my firm for a consultation, schedule an appointment, let us professionally manage your money. That way you won't have to worry about, is the stock market an all-time high? You can hire a firm that can actually manage the risk, upside, and the downside in order to properly position your retirement for success. Michael in Miami, Florida. I'm a nervous investor. I've been sitting in cash for the past 5 years. What would you do? Michael, what I would tell you is hire a real investment firm, a fee-only investment firm like Rezny Wealth Management. If you're emotional, that tells me you don't know how to manage your own money, and don't feel bad. Most investors do not. In fact, most individual investors who do their own money management do a poor job because they really don't have the time or the discipline. They buy random investments, they hold them, and they sell them at the wrong time. So at the end of the day, if you're emotional, that's the exact reason why you want to hire a real investment firm that can help control the risk. Rezny Wealth Management is a professional money management firm. We're not a Wall Street company. We don't sell investment products. We're a fee-only money management firm providing real money management and downside protection. I'd suggest call our firm. You can also visit my website, reznywealth.com. Visit our website. You can learn more about our firm, how we manage wealth, and where our office locations are. Call my firm for a consultation, folks. I'm just about out of time today. Our office number is on the screen. Our investment offers investors just like you upside participation, downside protection in severe down markets. We do not believe in set it and forget it asset allocation pushed by average investment firms in Wall Street. You know that failed pie? We don't believe in it, and we don't believe in riding the roller coaster all the way down. Call my firm for a consultation. Protecting your portfolio in severe down markets while capturing quality returns is the groundbreaking difference we offer investors. Call our firm, visit our website, reznywealth.com. Make sure you have yourself a safe and profitable day.